Hey everyone, super happy to be here once again. And today I have Antonio Mara Marrazzo, right? I
Marrazzo.
guess that I pronounced your last name perfectly. So I'm very excited. We're having like constant conversation for a while right now about quantitative strategies, factor investing, alpha. So I thought it would be a great idea to jump on a recording session and to record for you guys a short episode, a relatively short episode, but with a fruitful ideas that you can actually catch and see its value very instant. So I'm very happy for the privilege. Antonio, ¿qué dice? ¿Todo está bien?
Yeah, well, thank you very much for having me, Afik. As soon as you contacted me, uh, I was tempted. I was thrilled by the idea of joining and talking a little bit about quant strategies. So thank you for having me.
This is my pleasure, and I'm very happy to have you here. So before we're going to be diving deep, tell us more about yourself.
Sure. Well, I'm originally from Argentina, which it's a country with not, I would say, underdeveloped capital markets. So, capital markets don't have the depth of other developed markets. So, kind of the quant profession is not that common. Say there are a few quants only. I've studied economics and actuarial sciences, which is kind of apply statistics for the finance and the insurance industry. And I've always approached finance even without knowing the profession of a quant. I've always approached finance since I started investing, like when I was 18, 18 years from a quant perspective. I started doing my Python codes. I wanted to, optimize my portfolio, with Markowitz. As soon as I learned Markowitz at the university, so started to apply all the financial concepts I had, quant finance concepts I had, which I also saw in the actuarial science career, into code, and started building my pipelines, even without knowing that was I was meant to be a quant, right? But then I discovered how was the quant field, and I said, okay, this is my approach to investing. This is what sounds most to me. I think it's kind of when you talk about investing in capital markets, there are many approaches. There are not infinite. There are at least five or six approaches that have worked in the past, and I think that looking forward, all approaches will need to have a quant. Uh, at least something of a quant approach, and so that's why I took the decision of embarking in this field.
Mhm. That's very interesting. So let's talk about some quantitative strategies. I would like you to explain me more about what do you do in general. How do you tackle financial assets? How do you tackle portfolio construction in the first place? And how do you think about a strategy or a tackle to approach the market in a very creative manner?
Well, that's a really good question. So my approach currently, and yeah, I would say, yeah, in the last few years, is around factor investing mainly. So trying to find factors that have a risk premia. That's the first thing to do. Factors that are sometimes, I mean, the best thing is to find factors that are orthogonal to traditional factors such as market size, momentum, right? In order to, be able to diversify across the book. But secondly, I would say the most important part, and the part that I found like most interesting over the last years, is being aware of the data generating process, which means being aware of the regime and how each factor behaves in each regime, right? And so I would say it's that my approach is twofold. On one side is factor investing, and on the other side is how to dynamically allocate to these factors given the regime, given the data generating process, right?
Mhm. That's very interesting.
Yeah.
Um, and let's talk more about the factors because I
Yes.
do see like the role of factor investing is actually there is the effect of the chicken and the egg because all the time seems like it aims to rise dramatically, but you realize that no, it's not the time. It's not the rightest time for it to rise. And I want to question you in a strict manner. How do you approach a factor? How do you construct it? How do you think about an occurrence or a thesis to tackle the problem?
That's a really important questions, because if you test a thousand of factors, you'll most likely find something. You know, you must most likely find some factor that is significant, and this is a really, um, I mean, this is a statistical error. So you shouldn't be testing factors. You shouldn't be testing across the factors too in order to check what works and what doesn't. In my case, I would tell you that and this is something that Lopez de Prado remarks, and I think it's important to find there should be a causality relationship between the factor and the return. That's the first thing, and it should be marked in some economic theory, right? There should be some rationale behind why the factor drives the returns. If there's no rationale that could explain that risk premium, then it is maybe you're finding that that factor is significant just by purely chance, right? Also, if you're testing a lot of factors, you should correct the t-tests, but the amount of trials that you're making, that this is a mistake that in most papers is not done. And I would say in the last part, you should be aware of the universe you're testing, because there are a lot of factors that are significant because they are basically tested on microcaps, sorry, you know. And what happens is that these microcaps are actually not tradable, right? And so you should be actually testing against a tradable universe all the time if you're using a factor. And if it passes all these tests that I mentioned, well, then you have a factor that you could actually um, trade, right? That at a first glance, I would say you should do paper trading with that factor as well, right? Anyway, you never use just one factor, right? The current models are multi-factor, right? And as I was mentioning, the allocation to each factor should vary depending on the regime, right? Each factor has a regime. That's what I think, you know. For instance, and this is proven by the Academy, momentum performs better on low volatility settings, right? And
Hmm.
short-term reversal, which is kind of the opposite as momentum, operates better in high volatility settings. And there's a rationale behind that, right? Uh, if you are in a high volatility setting, you might get blow up by trading momentum. And you know, in high volatility settings, the drawdowns are higher, and you know, um, downside volatility is always worse than high volatility. And also, in high volatility settings, you get rewarded by providing liquidity, right? Which is going long on the short side of the short-term reversal. And and then it makes sense that short-term reversal outperforms momentum on high volatility settings, right? So it's kind of trying to understand why you're profiting, what you're profiting from. There should be a rationale behind that. Um, and well, also that the universe you're testing is the actual universe you will be able to trade, right? With the correct assumptions and everything. Sorry for the
Hmm.
long response, but I think
No,
it's
long responses are totally acceptable here. Um, okay, so let me take that conversation a little bit further because I do think that factor and factor construction and factor initialization in matter sense are very very tricky because factors are actually having a proper due diligence across universe of assets and across multiple asset classes, and how do you think it is the rightest and the most honest way to evaluate a factor across multiple asset classes? Let me just
yeah.
let me just
You can reframe that.
let me
Yeah.
just enhance the conversation a little bit more. Then by Two Sigma, they're having like a double model for so first and foremost they're using Lasso, and by the way this is all public, you can access the information, and then they use OS if I'm not wrong. So this is like a multiplicative process where you are able to orthogonalize the factors and to extract the rightest information or the rightest understanding of which of which information is the most accurate for you to build a proper understanding on top of. And my question is, after
Yes.
constructing a factor, understanding what would be the most rightful test to test if this factor is applicable across multiple asset classes.
Um, Sorry, can you reframe? So your question is more on the application side rather than on the testing side. Is that right?
Sure.
Because okay, uh, what would be the right? Can you reframe that? Sorry, a little bit. Repeat that question again.
Yeah. So I'm asking that when you're building a factor, or when you're thinking about a factor, you're
Yes.
mostly eager to understand if it will work on multiple asset classes. On your mind, what would be the most resilient methodology to test that factor over a multiple asset classes?
Um, well, I think you should. I mean, the way you the way you test a factor, suppose you're doing the, Fama Macbeth regressions, right? You're just testing that if that actually you have a risk premium that is significant, right? You should use the same methodology across all asset classes, I would say. I think that's an important caveat to take into account. I don't think, honestly, that I think a factor should be persistent and replicable across the same asset class, but there could be factors that, I mean, I don't think that for a factor to be significant, it should affect all asset classes equally, right? Because all asset classes may have risk premiums that are different. Anyway, if your idea is to see if there's persistent across different assets, I think what you should do is actually use the same methodology. And maybe your question goes into, okay, maybe there's a different data representation for the different asset classes, and you might deal with a problem there. And I think you should try to have as much similarity as you can on the data representation process, right? uh, in order to hack out of the same time series, right, to test the same windows. I think that's pretty much important. Yeah.
Mhm. Okay. So let's shift from the conversation about factor and factor investing towards the data.
Yeah.
And I think the data is the most luxurious and the most overrated asset for a quantitative researcher. And in a matter of fact, data can be used to test multiple ideas, but on top of testing multiple ideas, data is supposed to be cleaned and supposed to be found without any anomalies. And my wondering would be that how deep you take your data analysis or your data cleaning processes, and how do you enhance and ensure that your data is clean before you start working with it? Like, what are the most important criteria that you're looking at? Do you align time zones? Do you align spreads and slippage? And so you would be able to aggregate how the data is actually being constructed, which is a methodology that I heard in one of the recording sessions that haven't been uploaded since the day that we're in. I think it will be uploaded in 2 weeks time. But just back to the topic, I really want to hear what do you think about running the data and ensuring that it will be enough reliable to extract information from it.
I think that's a really good question, actually, because it's really important. Like aligning timestamps it's really, I think it's really important. I mean, the first caveat, I mean, for data to be right, it should be backtest ready. I think that's a uh that's the main thing. So, being aware that there's no look ahead bias at all, that time zones are okay. That's important. In the cleaning process, it's important if maybe you're dealing with macro data and you need to interpolate because you have to align a daily series with a monthly series or quarterly series. Okay, how you how you interpolate, it's really important, because you gotta your series has to be as faithful as possible as the real behavior of that series over time, right? Like how does GDP behave? Is it better a linear interpolation? Is it better a quadratic one? Is it better to use splines? It's better, right? So being aware of that, I think it's really important, because in the end you'll match daily data, and your daily data of how GDP evolves to be as faithful as possible to the real time series, right? So on filling gaps, I think that trying to emulate the series as better as you can is important, right? And there are many techniques to by checking the error of the series to basically know what interpolation method is better, and you should really pay attention to that. On the data, because data cleaning means many things. I would say you should be. I mean, something that you always do is check how many nans you have, how many nulls values you have, why those values occur. Right? You gotta really enter into why you have the data that you have. On the dates, it's important to check not only the dates I mean, you should always use the date that you're actually seeing the data, not the data. Sometimes you have, for instance, an unemployment number, and that is released the first week of the month, but it's actually 1 month later, right? And so you should be aware that an employment number in the past, you wouldn't have it for April, you will have it in May. You know what I'm saying? So it's like you should be aware of what that is point in time data, right? Which is kind of a broad word when we say it, but it requires all of these caveats of knowing when you would actually have the realized number, not actually when that number referred to. On the
Mhm.
backtesting side, this is really important because you need to account for all the constraints, and this is particularly important in backtesting, right? Especially if you're dealing with short, with a short strategy. Uh, it's actually pretty hard to have short interest historically sometimes. I mean, Nasdaq has the data, but sometimes you gotta estimate it, right? Same with beta
Mhm.
spreads, right? Beta spreads is like you might have the data, but if you don't, you need estimation methods, right? Estimation methods, I mean, there are many that uses, the liquidity of the stock and other type of factor to actually estimate what would actually have been the beta spread, because you should take that into account, right? If your strategy does not survive the actual beta spreads, then it's not a profitable strategy, right? Liquidity constraints. What Sometimes there are factors that are really appealing to short when looking backwards, but when you take, but you might not have what was the real short, um, what was the real lending rate for that short, right? And so you should take into account actual lending rates. And if you don't have them, you gotta make assumptions, and those assumptions should be conservative enough so that you're actually testing accurately. Um, so I would say that's on the backtesting side. I would say it's pretty important. I hope I'm not forgetting anything. Um, and on the data cleaning side, what I say, I think it's actually pretty important. Uh, Not paying attention to, being aware of outliers as well. What is driving the factor performance? Maybe it is an outlier. Uh, and might not be that bad. I don't know. It's like I usually work with winsorization, for instance, on that case. Um, but getting back to your question, I think the data cleaning is essential. I think it's a big part of the work. Um, and and yeah, well, another thing is actually having the tickers that you would actually you for instance, if you're working with an index, you should be, sorry, there's someone passing here. If you're working with an index, you should have the point in time tickers that work, that comprise the index at each moment, right? You should work with listed equities. You should work with maybe equities that are out of the index currently, right? There's a lot of mistakes by backtesting, for instance, the S&P constituents and only using the S&P constituents nowadays, and that's a real mistake because you have survivorship bias, right? So, you know, being aware of all those biases that could affect your performance and actually fool yourself with is essential on the data cleaning process. But yeah, paying attention to dates is really, really important. And there are some things around the data that I mean, if you look at cost of goods sold, for instance, for across different providers, I have done this exercise myself. This is a figure that is actually pretty variable, right? Across providers. Like if you check in S&P Capital IQ, and then in Bloomberg Refinitiv, there are some figures, from financial statements that change a lot, and you cannot. That is difficult to fight, but I would say that it's actually also important to check how do the financials look like if you're using financials in your factor construction. Because they can change dramatically the results of your research. And that happened to me a lot when replicating papers from other authors. That yeah, they may have had other types of figures, and that might have changed dramatically the result.
Mhm. Very interesting. So, well, you have literally covered relevant information about data and cleaning data, but from the data, extracting meaningful information, it's. I think that's the trick. So, after you understand the data and you have a very high familiarity with it, how do you extract, or how do you think about trading ideas or capabilities that you can extract from the data? So then you will be able to gather onto a training thesis.
Oh, that's a really good question. I think there are two ways of doing quant research in this matter, or I would say three ways, and that's my experience. Um, the first one is you can actually check what's going on in your book, right? And say, okay, maybe there is something here, or maybe my hypothesis of what I was trading was wrong here, and you can actually tune that and do research based on what you have on your book, on the results that you've been having on the past. The second one is actually getting a piece of research from somewhere, and this goes to your point. I'm sorry, but I'm actually telling you how do I envision this. Actually getting a research paper and trying to replicate it. And the third one is what you tell, that is actually having the data, looking at the data and see if there's something, right? Which is kind of uh, there are no shortcuts there, but it's kind of the most research uh, the actual research approach, right? And on that, what I do first of all is trying to understand the statistical nature of all the variables that I'm using, right? So I look at the variables and I say, okay, how does this variable behaves? Is it stationary? Is it mean reverting? Does it have fat tails, right? Trying to first ask what's the statistical nature of all my variables that I'm using, given the particular problem. I do statistical tests to actually, if something visually seems to have a fat tail behavior, I actually test that. I do the same. I test normality for some, and then it actually, I would say, I cannot give a straight answer to your question because I think it really depends on the problem. What are we trying to do? Are we trying to check predictability of variables to the other uh, to other ones? Are we trying to check? I think it really depends on the nature of the problems, right? I would say that's the second one. And so once I understand the statistical nature of my variables, I'm in a better position to kind of address the problem I'm addressing, I would say. Um, I don't know if I
So
answered directly, but you can give me an example and I can maybe. Uh,
no, I will tell you that um,
and so basically, I would say that depending on the characteristics on how is the problem, uh, I also look for external research to back my ideas. Sometimes ideas don't flow naturally, I would say, and maybe the data analysis process either, right? And so you got to check for external sources. And this is particularly important because I would say me myself, I have a bias, and it's important to know your biases. And I think this is also true across many quants, but I have a linearity bias, right? If I was checking, for instance, uh, and I, as I've worked a lot with time series analysis, I would actually see impulse response functions. I would check if there's causality relationships between variables, and so, but that's all on the linear space, right? Which is, I think, it's the first dimension to test. If I was testing, addressing a problem in which I want to check predictability or whatever, uh, but there are many layers beyond that, right? And markets are nonlinear, I would say, which is kind of pretty broad saying nonlinear. And so I also check for how other people approach the same problem because there's a lot of research out there. Maybe it's not directly linked to my specific problem, but comes from other idea, and I can match topics. And I would say that's the second part I do. I really It's one of the things that I enjoy the most, the fact of actually checking for research that could address my problem. And I found that it's really productive,
And if
actually.
and what
Yeah, sorry.
what will happen if you don't
Sorry.
find a research that tackles your question?
Oh, that's a good question.
Most of
I
the time, you
think,
won't find something, or you
yeah, I
will.
would say
I don't know.
most of the time you won't find something. Yeah, I think that's a good question, because when you don't find something, and you have a hypothesis that is actually, I mean, you're saying, okay, you're trying to spot a behavior, you're trying to spot a pattern, right? And what you would say is, okay, what is actually the pattern, right? Uh, is there a pattern at all? I want to stress test this. And sometimes what happens is you have that pattern, you want to stress test it, and there are only some outliers that prevent that pattern from being actually profitable. And so I checked on what is driving those outliers. I would say this is kind of pretty specific, but it happens a lot, right? And so if you could build a strategy in which you can actually take out those outliers, or add in a layer of filtering so that you can actually trade better, I think that's really important. And if going back to your question, I think that knowledge is cumulative, and there are many approaches to um, I mean, for understanding how something behaves that is done from a particular perspective that might not be directly applicable to my problem, but that way the problem was addressed, give me ideas of how can I address the next problem. You know what I'm saying? So, um, I remember one of the first papers I read did dummy regressions on the VIX percentiles to how the
Mhm.
S&P would behave. This is a 90s paper. And it's like, oh, what the hell? What they did is, they divide the VIX, actually the VIX levels on percentiles. They made dummy variables with that, right? So you have a panel of dummy variables, and you could predict what was gonna be the return of the S&P. And this actually worked pretty well for that time being, from the 90s on until 2010. Then actually, it's not that easy to, I mean, it's not that clear that you could actually trade the S&P on mixed levels right now, or there are more filterings to for applying that. But that idea of using those dummy variables for percentages for predicting returns actually really helped me on other types of problems that didn't involve the VIX and the S&P. I'm talking about the methodology. Um, so so I think that's really, being able to accumulate knowledge, and also extrapolate things from other uh, from other fields is actually, um, is actually really useful, right? I actually use, for
Mhm.
instance, I've been using a lot of network theory because it's something that I've learned last year. I got into learning network theory, and I didn't learn network theory for finance. I learned network theory for everything, like signal processing and things that are not really, or cascade effects, social processing, not directly related to finance. It's just to trying to train my mind to see problems from a different perspective, because this might be applicable to finance, right? And I actually train um, a graph attention network for trading um, country indexes, right, based on their trade relationships, given what I learned on network theory. It wasn't that tradable in the end, right? It didn't pass some tests, but it was actually a way of training my mind to address a problem in a different way, right? With a new
Mhm.
model, right? Because there are plenty of models out there. So that's why I would say. Uh, and and as I mentioned, I think that checking for external research is something, it's just to lower your anxiety sometimes when you don't have an answer, and actually having shortcuts a little bit, but yes,
Mhm.
as you mentioned, most of the time you don't have that.
You don't have that. You just don't
No.
have that. So let me take that conversation onto the last, and I think the most interesting topic of the conversation, for my end at least, that would be machine learning. Now, machine learning, obviously, it's a thing that we are constantly talking about: machine learning, machine learning, machine learning, machine learning, machine learning. And you have a background in machine learning, obviously. I want to ask you, how do you accept machine learning into your models? How do you think about machine learning? Where do you actually use machine learning? And in general speaking, what type of machine learning models do you actually use in practice with your production models?
Well, that's another question, because I really like machine learning, but I think it's really important to take it seriously in the way you approach it. There is a paper, I just don't remember the authors right now, which actually trained different machine learning models across the same factors and show that performance didn't vary that much. And why is this important? Because this, I mean, they train a logistic regression, a random forest, XGBoost, and so, and they show performance didn't vary that much if you were using the same features. And this is important because there's so much attention that needs to be paid to the feature engineering process, right? This is the data side that we covered before. So I think that's the first thing. The second one is machine learning could be helpful on the research process, right? For instance, there are two factors that might not work together, that might not be significant if traded on its own, but if you see them on a machine learning model, you can actually check that they have relevance. For instance, if you combine short-term reversal with illiquidity in a random forest, you see that those two variables have really high feature importance, right? You might lose interpretability, uh, but you might be able to address the nonlinearities we were talking about. Uh, but yeah, once again, I think prior to using a machine learning model and putting a lot of factors and trying to see if there's, I mean, you'll most likely find something. You gotta be careful on which features you're using. That's I think that's really important. And also, then what are you minimizing? You know, because if you are actually wanting to not lose that much capital, okay, you might want to minimize mean directional accuracy instead of just mean square error, right? I think that, and this is shown also on the research, classification models for returns work better than just trying to predict returns, right? And so when using machine learning, I think it's more I think it's relevant on the classification side. um, kind of trying for outperformance or underperformance of an index, trying to, you know, yeah, train for positive or negative returns instead of just, you know, predicting the actual return, the absolute return. Um,
Hmm.
so yeah, the steps would be paying attention to the feature engineering. What am I putting into my model? Does this have any rationale behind? Okay, that is good. Secondly, um, I would say I tend to use recursive windows so that my training data expands over time, right? Uh, Also trying to not don't pass through tests that much. Uh, and in validation, just do a research as simple as possible. Uh, don't do that. Don't tune it that much, and trying to uh, and and yeah, cross cross K
Hmm.
validation, all the different K bits, and depending on the problem, what are you paying attention to, right? Some problems might require more attention to precision than recall. Some others to recall rather than precision. Maybe you're just, I mean, the F1 is not what matters, or the accuracy is not what matters on its own. Balancing correctly the data set, all the caveats that are important to take into account when using these models. But I found them really useful on classification tasks. Yeah, absolutely. For instance, will this company go bankrupt 2 or 3 years from now? Okay, you may be able to predict that. Uh, will this company and yeah, will this company outperform the index in the coming year, given these factors? Maybe that's the right question to ask and to train a model on, a
Hmm.
machine learning model on, right?
Hmm.
I think
Very,
yeah.
very interesting. Um, okay, so let's go back onto the feature engineering as of the last question for today's conversation. Um, what critical uh what critical steps do you take when you're doing that feature engineering step? What is your important uh, factors within the process that you're looking at in order to fine tune it to be to yield the better results after post training?
After post training, right? You tell me.
So post training and after that pretty much the same, but I use pretty much better syntax with post training. So feature engineering, from understanding the data toward understanding the features towards building or selecting the rightest model, and then knowing how to accurately anticipate good or intermediate results within your post training processes. My question to you is, how do you map and how do you work on your features to be the exact features the model is supposed to be fitted?
Okay, yeah, I think this actually relates a little bit to the data part. And in feature engineering is, I would say, it's not about clever transformations, uh, but more about not fooling yourself again, right? So the data is noisy first, almost always. Uh, it's non-stationary. It's adversarial, right? So most of the critical steps are actually really disciplined around leakage and validation. So the way I prioritize feature engineering would be to, first of all, um, eliminate look ahead bias. This is the one that ruins everything. So you should, every feature must be computable using all the information available at the decision timestamp. Um, you know, don't
Hmm.
use a day's close to predict that same day, applying full sample statistics for normalization, restating financials, be aware of that were revised after the fact. That's a really big error. Uh, and also aligning the data to report dates rather than the date it was released. Um, use point in time data to fix survivorship bias. Uh, you must include the listed bank acquired names. Then I would say, um, you should, I mentioned prices are non-stationary, so you should actually transform for stationarity, uh, but also, I mean, use log returns mainly, right? Um, I mean, using log returns, you're closer to stationarity, but you might lose memory for the returns. This is kind of a, I would say, yes, you know, so maybe if you use fractional differentiation, um, you're in the middle ground to not lose memory and also to have a series that is stationary. So that caveat, for instance, for price data, I think it's important when we're talking about feature engineering. Um, so your difference in a way is just enough to pass the stationarity test while retaining as much predictive memory as possible. I don't know if I was clear on that, but I think that's I would say principle for transformation. And also the labeling is a feature engineering problem, right?
Hmm.
We were talking about um, classification, and so like what are you actually what is your fixed horizon, right, for returns? What is kind of how do you level, right, the the data? Is it profit take, stop loss, uh, you know, time barrier
Hmm.
that would hit first, right? That would give more realistic tradable levels than just, a fixed horizon return, right? Because in the end, you will face these constraints when trading, right? I think that's an important caveat on feature engineering. So having kind of, and you can address that, but having both like the fixed horizon returns, which might be a weak target, but also important for training, but also have doing meta labeling, right? To have a maybe a secondary model that decides on this yeah on whether to act on a primary signal on and how to size it, right? And what else can I
Hmm.
say on feature engineering? Because
Well,
there are
feature
many things,
engineering is obviously a very, very long conversation about, how people are actually interpreting this process in general. And I think that there is no straight rightful answer for it. And
Yeah, one last thing I would say is to
yeah,
handle overlapping samples and
please.
serial correlation, right?
Hmm.
Which is when labels span overlapping windows, uh, observations are not independent and identically distributed. So that would inflate apparent significance, right? And so to use sample weighting based on level uniqueness and concurrency, and sequential bagging if you're bootstrapping or whatever, I think uh, I think this is widely ignored and is a mature source of overconfidence. So yeah, um,
Hmm.
and well, validation with time aware cross validation. I think that was redundant, but yeah, to having time aware cross validation, I think it's important, right? So don't do kind of standard k faults because that could take future into past, but use post k fault with an embargo, right? Same as normalization, right? You do expanding normalization over time if you're standardizing data and not normalizing across the whole series, because then you will put in future data into your series. And this is I think that is maybe you're saying, okay, why are you clarifying that? But it's because there are so many research papers that do exactly that, and that's a real mistake.
Yeah.
So yeah. And
Yeah.
also,
Well, I agree with you on
yeah,
that topic.
yeah. So I think I really told you my methodology on that matter. Uh, being paranoid also about multiple testing, baking transaction costs. Well, that sorry. Uh, But
Yeah.
I think yeah, I gave you a real big uh, journey through feature engineering.
Yeah,
Uh,
first and foremost, I do think that your notes were lucrative in a sense where you were mentioning what is actually important when you're trying to locate those features to build your reliable system. And I really want to thank you for that conversation. I really enjoyed it. It was very detailed and very down to the point. And I really want to say that I'm very appreciated and thank you for coming to have a podcast with me.
no, thank you very much, Afek. It was a pleasure talking with you. Those were really good questions, actually, and I could talk for hours, honestly. So sometimes it was a bit hard for me to.
We can talk for hours, but people will not live less than 4
Yeah,
hours.
absolutely, absolutely.
That's the
You know what I'm
point.
saying? Yeah, like, but each question, could drive has a lot of branches and things to discuss about. It's super interesting. So thank you very
Obviously,
much and congratulations
obviously.
for this initiative. I think it's great. It's great
Thank
to
you.
have something like this, a podcast like this.
Thank you. So thank you everyone, and thank you Antonio for coming. It was a privilege to have you. See you on the next time on the Blushing Quants.
Thank you.